This is the Viper Report market wrap video for the week ending October 10th. I don't think many, myself included, expected this kind of end to the week. Of course, when I should have thought that it's been since May since we had too much tariff nonsense. So we all know that in this environment, somebody likes to always be in the front of the news. Do I think those 100% tariffs will last? No. I mean, I think the taco thing is going to come through again. Do I think the Chinese expect it? Highly unlikely. As far as what the Chinese do, I don't have a clue there. They could be getting tired of this too. This table shows you what the readings are from the watch list. Quite interesting. Last July, I started pointing out that we had 80%, a little over 80% of the ETFs in the sector report above their quarterly pivots, and 76% in the themes. That, looking back to 2023 and the July highs, that was a sort of a danger signal. You can see they dropped the next week and then they rose back again, but gradually the trend, has been downward. Last week, for example, it was 53.3 and 66.9. This week, 37.2. So that's like a 16-point drop in the number of markets above their quarterly pivots. 53.2, that's a drop of about 13%. So the warning's back here. The lag time, unfortunately, we haven't been doing this only for a few years, so we don't know yet whether that's a normal lag time or not, but we'll figure it out. For the week, the SPY closed down 2.4%, and you can see right now it's at 653, and with the 20-week EMA is at 632. So roughly about just over 20 points, and the R1 here at 640. It's like any level of resistance. Once resistance is overcome, it becomes support. And then, of course, major support, goes back into, the high from early in the year, this line A, which is right in the 610 area. So we look at the advanced decline line. It's still above its EMA here. And did make a marginal new high a couple weeks ago. So, as it makes new highs, it suggests that any following decline will be a decline within the uptrend. That's still the view here. You can see major support on a weekly basis at this line C. We've been looking for the bullish sentiment to rise a bit more, from back in here. We went from -20 to +10. So that's just an indication that last week's reading, there were 10% more bulls than bears. That's not going to last. So I would think, given the severity of Friday's drop, it'll probably drop down towards the zero line or lower. Get a mixed picture when you look at the other AD lines. You can see the stocks only is the weakest. It formed slightly lower highs a week ago, and then has dropped sharply below its EMA. It's right back. Stocks only, of course, does include not only stocks, but bond funds, etc. It did make a new high with the NYSE composite, and it's pulled back, but still above its EMA, and this shows this band of support, these red lines. So that's kind of where we're looking for this to drop to. Could drop below the moving average this week on follow-through selling. But on a near-term basis, probably Friday action will encourage some bargain hunting. On Friday, 68% of the S&P stocks were lower. Even worse on the S&P 1500, the small caps really got whacked, down -80% decline, and 73%, for the NASDAQ 100. Looking at the daily AD lines, you can see this is goes back to the April lows. The bottom, was triggered back here in April and then into late April, and then in May we got a new high, so that was a sign that the market, at this point was ready to make a new high as well. So we did see a daily divergence on the at the last high early in the start of the month, and so we have this daily divergence, all right, and a break of the uptrend on Friday. So it is already getting down to first support, so that's a sign that probably we are due a bounce next week. If the bargain hunting is heavy, which I think probably a bunch of people do subscribe to the taco conclusion, we could just zip right up. More the negative side would be a failing rally midweek that would take the AD lines back to their moving averages right up in here, and that would set the stage for a further decline and possibly a drop down to this AD line support going back to the end of July. The daily AD lines closed the week negative. You can see the dramatic plunge in the S&P from a high just a couple days ago down to support line A that goes back to the July and early August lows, line A. So as I said, we'll probably get bounce from this level would be a good sign. How strong a bounce will tell us where the market's situated going forward. Stocks only also looks weaker on a daily basis. It has already dropped below the July lows here, and now support zone goes down to the lows that we saw in May to June period here after the first major rally phase. That should be quite good support. If you extend it through, you can see that's also corresponds to the levels we saw during the February, March, and April decline. Stocks only, the all AD line rather, does show that same divergence, with support, down not too far below where we are currently. Let's look at the QQQ. The weekly chart shows you it closed down 2.2%. Look at the levels to watch here. The R1 resistance that we came a number of weeks ago. It now stands at 571.41. So from the Friday's close, that's down 3%. And then we have the rising 20-week EMA at 564.40, and then the Stark band at 553.64, right around in here. That ranges from a decline of 4.2% to the 20-week EMA, or 6% if we get down to the weekly Stark band. The AD line here is still above its EMA on the NASDAQ 100, with converging support down here. Since the low in the fall of 2022, it's always been holding up, better than the SP, certainly, and quite a bit better than the New York Composite. So this chart suggests that's probably going to be the case this time. So if you look at the daily chart, the magnitude of the decline, 3.5% on Friday, took the NASDAQ 100 AD line right back to the support level. So, not necessarily a big deal at this point if we break that support. I think it's fairly likely we will, even if you have just a slightly, negative AD numbers, it's going to drop below that. And you can see the relative strength is still in a positive trend, made a new high. The AD line made a new high too. So, once again, another sign that this correction should be again followed by higher prices. These one-off massive declines, particularly news-related, like this one was, are more often corrections within a major trend, not the start of a major top. This daily chart of the NYSE composite shows you, that the number of stocks making new highs dropped to 71, close to 200 a week ago. And the new lows rose to 122, but, still not really a massive move above these highs, but, a little more of a concern. On the NASDAQ composite, you can see, a little stronger, like we would expect, 192, versus 230, so it's still positive. That's probably going to change this week. And, new highs, you did a pretty good job of making new highs again about 500. So, as you probably noticed in the other chart, the NYSE new high, new low is a little, showing a little more weakness. More concerning last week was the action of the small cap. So this is the IJR on a weekly basis. I've been mentioning the fact that the AD action looked really bad. Now it looks even worse. It broke this uptrend here, so that was one of the few warnings we had, up to this week's action, really. And it never, in terms of the AD line, it made it up and through the July high, but since then, it's formed another divergence and a further divergence. So that suggests that if we get a multi-week decline, things like the IWM and the IJR are going to be hit the hardest. Also a big move in the VIX and the VXN. We've been looking at these support levels. So the start of the week we saw that this had kind of broken out, pulled back to the moving average. So this sharp rise up, it's only up to 21, suggests this is the start of a correction. So we're going to see what kind of pullback. If this pulls back into the 19 area or so, and stabilizes, that would suggest that, it's just an oversold bounce that you can see we closed well below the Stark bands here, and they'll be probably followed by another push to the downside. Similar with the VXN, we saw, it could be something similar to what we saw in late July, that August 1st, we had this reversal, down gap, got down to the lower Stark bands, and, that was it, for the VIX and the VXN. If we look a little longer term, let's go for a year and 5 months. We'll lose some of our trend lines, but that's okay. You can see what happened at the April low. We got this nice really move up to about almost 30. We got a pullback here. It's classic sort of rebound up to the declining 20-day EMA before the plunge accelerated. So, that currently we don't have enough information to say that's not possible, but certainly bears watching. In other words, at this point, to turn this back to positive for stocks, we need to see it just roll over and drop back below its moving average, which, given the way we closed, that's probably not going to happen in the near future. Well, Friday's plunge looks most dramatic on the 260-minute bar. You can see that it gave a buy, and then, after the news of the tariffs hit, it quickly reversed to the downside. Oftentimes we've noticed in the 960 we get a number of sell signals, stopped out here, sell signal, buy signal, stopped out, and then, a buy and then a sell. It's often a sign of increased volatility and a likely reversal of trend. If we look at for next week, we look at for the futures. Of course, everyone will be watching those later today to see how we fare. So you can see the pivot for this coming week is at 66.35, 34. So yeah, not far above. We closed at 65.52. So it's about 80 points above where we closed. Clearly, in order to this kind of downward momentum, you probably need to, the stop says we're at 678 to 695. So 678, 695 means at this point we'd have to get way up here to stop out the short position. So, that more likely we're going to see either further selling or a bounce back up into the zone and back above the pivot before we can get a new positive signal. So back to the market watch. Interesting that the leveraged long ETFs, only 50% are positive, based on the quarterly pivots, and none have daily DTS, and short leveraged, okay, none are above the quarterly pivots, okay, they're still negative on that basis, or have weekly, so that's all gone. 100% are positive DTS. So I think I mentioned a couple of weeks ago, that's the early sign that we would like to see if we're going to see something worth buying the inverse, given the severity, of last week's plunge. Certainly would not be shorting on the open Monday, but look where the risk can be managed. Overall sector review here, not a lot of positives. 91.7 on the XLV. The healthcare has really acted well. 91.7 on the utilities, which we've been expecting for. But other than that, there's, XLK got whacked, but it's still at 66.7, and it's really the only one that's significantly above the 50 level. So, XLU was up 1.5%, and as I said, SPY was down 2.42, and all the rest of these, XLI, XLC, XLRE, XLB, yada yada, were down more, and XLE was the weakest, down 4.2%. For a 3-month basis, XLU's been leading the way. We've been long XLU for about 3 months, and for a while it wasn't really holding us up in the end, but it still looks pretty good. I just regret not being an aggressive enough buyer to add to that position. So, all these are leading. The SPY was up 4.6 in 3 months. XLK 8.5. XLC, whatever this is probably, it's up about, I would say, 7%. And, if we move down here, the relative performance is quite interesting. So consumer discretionary, we got stopped out of our position. It's right up in here. We said it could go either way, and of course it's plunged now. That's suggesting that we may see some more negative news out of the consumer. Consumer sentiment's not been great, so anyway, it's oversold short term, and intermediate term's looking more negative. XLC is also a problem. We're still holding on to our position, so we'll be watching a rebound in XLC. Healthcare, we've broken the downtrend above this high here and above the downtrend, and utilities still look great, and the RS analysis on XLK still looks good. So if we look down into some of these positions, there's more or less technical damage. If we look at let's look at expanded version. Those of you who get my report and have stock charts, obviously can click right on that bar and then go in and look at what's going on. So like you look at XLK, you can see the huge massive volume. The RS it's still outperforming the S&P. The OBV is testing its moving average, does not really show a classic top formation there. And a big disappointment was ITB. I really thought that at late September we were going to see a decent rally, back up 112, 115 maybe. Didn't give it, so we took some profits out of it. We'd sold half, and then we got stopped out of the other half. Gave up some of the open profits, which is never comfortable. QQQ, it's cracked pretty good down 3.47, but it's already getting back into support. So, is it, you can see that this, we have lots of support back here, 573, 582, and we closed at 589. So, the monthly S1 is at 571. So I'm not sure it's time to throw the baby out with the bathwater here. So let's go back to the sector report, and we go down here to see what the signals were. Oh, we have the vanguards. Got to see some differences. So the VNQ, healthcare, all these got negative weekly, and a bunch of them most of them are in 3-day. So the world FTI, that'll be interesting to see. It's negative here, as is the emerging markets, and the industrials. Only positive here was healthcare, gave a monthly positive signal. Looking at the sector report, surprisingly there were some positive action, weekly positive signals, as well as 3-day, 3-day in Netflix, also Pepsi and EQIX, as well as CCI. Not too many, however. So let's look at that breakdown. You can see, energy. I've been pretty much out of energy before I stepped in what I thought was a puddle, but must have been something left over from a horse. So, we took a hit on our position of XOP, but being out of this was a good idea most of the year, and looks like it's still in trouble in terms of crude oil. Materials here, let's expand this a little bit. Materials negative. Industrials, still no signs of a bottom. You can see there's not a lot of green here. 50% are above the quarterly pivot. And 50%, above. We have positive DTS, positive 3 DTS. So, right now, you don't see too many that are ready to turn the corner here, but there could be. Consumer discretionary looks pretty bad. McDonald's has a 1 hour. That's not enough to trade off of. So, that looks pretty sick. Consumer staples actually looks better. PepsiCo, as we noted before, and also some of the more conservative. Costco is also now 4 hour and DTS, as is. So a couple of drug makers here. Johnson & Johnson is pretty green across the board. United Healthcare, Amgen also. So Abbott and MDT, Medtronics, could look for some positive action from them if they get the 4 hour flips back. Then if we get a DTS, all the rest of these are positive. So that'd be a positive sign. Tech, Oracle, nice and green across the board. CRM also. Microsoft, daily DTS, but the rest is green here. So, it was trying to bottom out. The daily studies actually are positive on Microsoft. And so a higher close this week will suggest that's going to be the new leader. AMD, a new weekly buy, and it's already had the rest of its positive. And, communications, not really. Netflix again, and Google, and Electronic Arts. And utilities, ED, about the only one. News positive signals. Real estate, don't see anything there I'm interested in. So that's pretty much what I got for today's action. If you would like to get some specific advice on what, so if we're going to see a deeper correction, probably will last a couple of weeks. If, this was just a one-off, we could be up, 1 to 2% by the end of the close. I think we'll get a pretty good idea by midweek. And, of course, as always, we'll keep you informed of what we're seeing on Twitter. Take care and hope you have a better week than we had on Friday.